What's good, YouTube? It's your boy Zay. Welcome to my channel, First Generation Wealth Building. What's good, y'all? I want to thank y'all for tuning in tonight. We got a good one, got a really good one tonight, y'all. So tonight, what we're gonna do, or what I'm gonna do, and let me get my show notes up here. Is I was going to do a whole like 5-part series, but then I thought it would be a little bit better to actually go live and review it and get live interaction. So tonight, what I plan to do is walk through a few different 2023 global stock market outlooks, right? And so with these big institutions, they provide documents or PowerPoints to their clients in order for them to prepare for the upcoming year, right? And so what we're going to do is so we could be prepared for 2023 is we're going to get take a just take an inside look into what these different banks believe. Now, because these documents are very long, I've actually did some pre-homework and I've cut it down to some main things that we're going to cover tonight. So the 5 things that we're going to go through these different macro outlooks are or no, I'm sorry, global stock market outlooks are going to be the macro outlooks. We're going to look at the inflation, their thoughts on inflation and the Fed rate hikes, right? We're going to look at what are their thoughts on a recession. We're going to look at what are their tactical views, and then we're also going to look into what are their investment themes, right? Because those are the things that ultimately can help us as investors going in 2023 to better understand how to position and just have some knowledge as we get ready for 2023, because it's definitely supposed to be a rocky year. So you want to get a little bit of a head start. Now, disclaimer, right? Most of these reports, I believe, were published maybe sometime mid-November or even December. So we'll look at that as well and provide all the information. So again, it's gonna be a good one. Try to keep it under an hour and get through these, but it's gonna be some good information. Definitely, if y'all feel free to definitely drop comments in the chat. Y'all know I love that interaction. So we're gonna get right into it now. Before we get into it, man, let me go ahead and do a couple shout outs real quick, see who I got in the chat, and then don't forget to press that like button as well as subscribe if you already haven't. So let's see who we got on rocking with me. I got my brother Tim, of course. What's good, Zay? We got Brian in the building. He say yo. Got Ron. I got Q. He said yo. We got Calvin. What's good, Calvin, my guy? And I got my guy Andre. So that's all I see in the chat right now. But without further ado, we're gonna get right into it. So like I talked about, we're going to get into the macro outlooks. And so the very first one that we're going to start with is going to be Blackrock. So let me share my screen real quick and get this pulled up here. Now, let me know in the chat if I need to zoom in. I'm going to try to get this big. So the very first, the very first outlet we want to look at is going to be Blackrock, right? So all of these are free. Just FYI, you can go to and you can look at any institutional bank and type in 2023, stock market outlook. You can find these reports. After this video is over, I'll go ahead and take the PDFs and just drop them all in the description in the video. So the very first one. So let's get into what does Blackrock think about the macro situation, right? What does BlackRock think about the macro outlook? Or let's get into let's just kind of look at their overall thoughts, right? So the very first thing is these are the folks who wrote this, right? So this is very important. These are the folks, and if I need to zoom in, let me know in the chat. So these are the people who wrote this. So you got Philip, I guess Hildbrand, he's the vice chairman. You got Jean, he's the head of BlackRock. You got Wei, she's the global chief investment strategist. You got Alex, he's the deputy head of BlackRock investment. You got, I guess that's Vivek Paul, head of portfolio research, and then you got Scott Thiel. I wonder if he's related to Peter. Thiel. But as you can see, starting out with BlackRock, they said, look, the great moderation, the 4-year decade period of large stable activity and inflation is behind us. Basically, they saying, look, man, all that stable inflation, 2%, and the Fed struggling to get achieve its goal of 2% inflation. Like, that's behind us. Like, now this going to be a struggle to get it down to 2%, right? They say a new regime of greater macro and market volatility is playing out. A recession is foretold. Central banks are on the course to over-tighten policy as they seek to tame inflation. This keeps us tactically underweight developed market equities. We expect to turn more positive on risk assets at some point in 2023, but we are not there yet. And when we get there, we don't see the sustained bull markets of the past. This is why a new investment playbook is needed, right? So these are the words of BlackRock, right? They basically are starting off their 2023 outlook saying, hey, look, we're going to be in high inflationary times. You got a central bank that is on a course to basically over tighten, basically engineer recession, right? Because they want to tame inflation, bring inflation down. I'm going to translate all this. And tactically, meaning they are saying that they are underweight developed market. Now, developed markets would be United States, that would be, Europe, basically developed economies. So they're basically saying they're underweight towards equities right now. And that they expect to turn more positive, meaning that eventually they'll say, hey, it's time to buy at some point in 2023. Now, the biggest thing that I thought was key is that they said the sustained bull markets of the past. Now, this is where they're basically saying, look, you need to weather your expectations moving forward. We're not going to see those rip roar rallies that we were used to seeing in the past, right? So going into 2023, first things first is you got to temper your expectations, right? Let me see. So that is their executive summary. So let me find in their contents, I believe that was probably their macro outlook. Let's see if we can find their macro outlook. I don't believe they have a macro outlook. So we'll go through their tactical views, inflation, and everything else that we can find. So starting out first, let's see what they have laid out. So we laid out, and let me zoom in some more because I can see that's really small. So we laid out in the 2022 mid-year outlook that we have entered a new regime, and we're seeing it play out with persistent inflation and output volatility. Central banks are pushing. A lot of this stuff you can kind of skip through, man. I'm gonna be honest with you. I get to the meat and the potatoes of the main information here. So here, all right, what matters most, right? This is exactly what I'm looking for. What matters most, we think, is how much of the economic damage is already reflected in market pricing. This is why pricing the damage in our first 2023 investment theme, case in point, equity valuations don't yet reflect the damage ahead in their view. So let's talk about that for a quick second. Right now, back when this was published, one of the very first things that BlackRock said is that they don't feel equity valuations reflect the damage. Basically they think that the valuations are too high. Now, case in point, right? When I show you guys that PE SPX indicator, right? One of the sauce indicators, shout out to my guy Tim. That is what one of the indicators that I use to kind of gauge what they're talking about, right? So when I see this talk of them saying, hey, equity valuations are too high and they don't reflect the damage, well, we've talked about this before, in that for us to have 4% rates and have the market with a PE now 20, because it hit 21 and bounced off, but at 20, that's still too high. We shout out to my guy Dave. He'd be on Sativa Saturday with me. We said that in recessionary times, the PE is more like 16 to 18. So they are saying that, hey, valuations need to come down. So this is the words from BlackRock, right? So that's what they said, that what matters most is, number one, to BlackRock, is that they don't believe equity valuations reflect the damage here. And I'm also saying, if you pay attention, Larry Fink has been dumping Blackrock shares. So clearly he sees something ahead. And so yet we won't see this as a prelude to another decade-long bull market in stocks and bonds. So keep that in mind, right? Keep that in mind. They don't believe that we're going to see another decade-long bull market in stocks and bonds. So that's the whole weather your expectations, right? Let's see if I probably got to go a little bit smaller. Or how do I, give me 1 second. All right, there we go. All right. So going through. So the new regime, right? So new regime, their second theme is rethinking bonds. Now, shout out to the runners because we've been talking about the bonds for a long time, TLT. Now, quick breakdown of bonds, right? Higher yields are a gift to investors who have long been starved for income. At the end of the day, bonds have not been an attractive market for probably over a decade. And now that yields are up, the bond market is finally looking attractive. Hence, TLT, right? So it's about to be dope how all of these playbooks and stuff tie into the stuff that we talk about on Sativa Saturday, as well as like the sauce indicators. Because remember how I mentioned TLT might now be looked as more as like a flight to safety, and the correlation between the bonds and the market might be broken. Shout out to my guy Tim. If you watched his video earlier, his advisor was talking about that, and he did a whole clip, and it kind of validated like what I was saying. So BlackRock is saying the same thing. They're saying, hey, look, let's finish going through it, right? We like short-term government bonds, mortgage securities. We favor high grade credit as we see it compensating for recession risk. Let me pause there, right? We favor high grade credit. Again, one of the sauce indicators we look at, high yield corporate bonds, the HYG. Remember how it had a couple gaps, and I was like, hey, this is one of the real indicators for risk on right here. So that's like one of the things that they're looking at. And it has a very, again, it's way low, so it has a very good bounce, and it could do well, right? So it's pretty dope that we could tie all this in, right? And it says we see investors demanding higher compensation for holding them as central banks tighten monetary policy at a time of record debt levels, right? So their third thing, right, is living with inflation, right? So they see long-term drivers of a new regime, such as an aging workforce, keeping inflation above pre-pandemic levels, right? We stay overweight, inflation-linked bonds, both tactical. There's that word again, tactical, and strategic horizon. Now, what does that mean? At the end of the day, they're saying, look, when we had the pandemic, we forced all the old people out the workforce because we ain't want them to get sick. And now we trying to get people come back to work, and all the young people, they don't want to come back to work, right? So that, we got too many jobs and not enough workers, right? As far as them being overweight, if you know about I bonds, that's essentially what inflation-linked bonds are. I think the latest batch of I bonds, I'm not even going to try to guess the percentage because I don't want to misquote, but it's pretty darn good. So if you are, if you are an investor who are trying, if you want a really low risk, you can get inflation bonds. And I think I want to say the percent that they're paying out is like close to like 6 to 7%, but don't quote me on it, but it's pretty good. Like it's better than it's been in years because inflation is up. Right. And so that is BlackRock's like overall themes, right? That's their top themes going into 2023. And so what we'll do now is we'll take a quick look. Let me kind of zoom out because I want to just get to the meat and potatoes. I don't really want to drag them out too much because honestly, guys, y'all can spend some time going through some of these. But so I do want to go through some of their charts though as well. So if this will freaking work. Okay. So taming inflation would take a deep recession. Right, so U.S. GDP and potential supply 2017 to 2025. This is the trend, right? This is GDP, the red line, and the dotted line is the estimate of non-inflationary GDP levels. So a large drop in GDP needed to close the gap between demand and supply in 2023. So they're saying this was GDP. We had a big drop. GDP shot off like a rocket. This was the trend. We kind of came down where GDP is going up. Now, in order to tame inflation, and kind of get back on this trend line, we need GDP to fall a little bit, right? Which thus they're saying will cause the inflation or is the deep recession. So I thought this chart was pretty cool right here. Let me see. I'm trying to, yeah, that was one of the charts as far as their new playbook. This is where's their tactical views at? I think I didn't pass it to you yet. Yes, so tactical views right here, tactical views. I want to make sure y'all can see that tactical views. So in 2023, right? They, like we talked about, they prefer short-term bonds. We're gonna skip over that. I want to get to the good stuff. Okay, this is what I wanted to get to right here. Okay, in equities, right? Skip all that. What we care about is what they think about equities, right? Meat and potato. In equities, we believe recession isn't fully reflected in corporate earnings, expectations, or valuations. And we disagree with market assumptions that central banks will eventually turn supportive with rate cuts. We look to lean into sectorial opportunities from structural transitions such as healthcare amid an aging population, so they like healthcare, as a way to add granularity even as we stay overall underweight. Among cyclicals, we prefer energy and financials. We see energy sector earnings easing from historically elevated levels, yet holding up amid a tight energy supply. Higher interest rates bode well for bank profitability. We like healthcare given appealing valuations and likely cash flow resilience during downturns. So let's summarize what we just read and kind of broke down there. Blackrock going into 2023 is tactically underweight equities. However, the equities they are in, they favor energy, financials, as well as healthcare. And so we're going to, it kind of makes sense as those, healthcare has been holding up pretty good. Financials have started falling off lately, and so has energy. So it's free. It's kind of funny that this is what they kind of factor, or this is what they like. And so that's just what BlackRock is basically saying, right? So let's see. This is their new strategic approach. Yes, I did want to talk about the new strategic approach from BlackRock as well. And Michelle, so she asked a great question. So Michelle, when did this report come out? I'll go, let me see real quick. This was published. Give me 1 second, Michelle. Let's go look, because I want to say mid-November is when this was published, I believe. Where's the date at? Don't worry, we'll get to the date, Michelle. But I want to say it was like mid-November. So a new strategic approach, right? What they're saying about the great moderation allow for relatively strategic or stable strategic portfolios. They won't work that way in a new regime. So we think you need to be more nimble. So what they're saying is we don't see a return to conditions that will sustain a joint bull market in stocks and bonds that we experienced in the prior decade. The asset mix has always been important, but yet our analysis is getting that mix wrong. Could be as much as 4 times as costly as versus the great moderation. So, wow, they're really saying that this could be costly. The difference between the orange and bar yellow charts on zero or even positive correlation between returns. We got to skip over all of that. Our strategic views stay modestly overweight. Domestic equities, as we estimate the overall return on stocks will be greater than fixed income assets over the coming decade. So a bunch of like this is like things that most, this is the stuff that most retail investors we're not messing with fixed income and dealing with all of that kind of stuff. So like I ain't gonna front, I skip over a lot of that stuff. And the New World Order, skip over all of that. Skip over all of that. This was a good part. Their long view on infrastructure. So this is another opportunity for you guys. So this was we're going to take this from the private markets, but figure out how this flows into into our capital structure. So some of the things that they talked about here was the U.S. Inflation Reduction Act alone earmarks nearly $400 billion, which we kind of already knew, for investment and incentives in sustainable infrastructure and supply chains, right? And so basically what they were saying, where's it at? We believe infrastructure can help diversify returns and provide stable long-term cash flows. So there is a few, I want to say like not necessarily ETF or holding companies that are kind of like ETFs where they own assets that are within energy infrastructure and stuff like that, that you can invest in and gives you exposure. Once again, something that most retail investors aren't really looking at, but I thought this was pretty good information. Just, if you want to just, have more knowledge. So again, we could skip over that stuff. And then they get really granular into their chart, but it just goes into their tactical views again. So that's basically Blackrock. You know what I mean? At the end of the day, I said I want to try to get through these pretty quick. So when we summarize Blackrock, it comes down to three things for them. One, they don't feel that equity valuations yet reflect the damage. So you can basically say they're bearish the first half. They only their tactical views are high on energy, financials, and healthcare. And they also believe that we are going to have a recession, or that it's necessary for a recession to happen in order to tame inflation. So remember how those were the main kind of like 4 or 5 things that we wanted to take away from each of these outlooks. So now we understand where BlackRock stands going into 2023. Michelle, you asked a great question. When did this report come out? I do want to say that I read last year's reports, and just like all investors, you have to stay fluid. You have to stay agile. So your views can change, right? Now, I don't think their views are going to change that quickly, but let's see as 2023 plays out. They send out monthly updates, and you can see when they tactically turn. So that'll be something that, trust me, I will do an episode when I get that report that, hey, they tactically have turned. I'll go live and we'll know about it together. But that's basically Blackrock, right? So the next company or the next big bank that we'll look at is Vanguard, right? So BlackRock, the reason why we look at BlackRock is because they have probably the most assets under management. So we need to know what the big players are doing. Behind them, you got Vanguard. So when you look at Vanguard, now the thing about Vanguard is this. So Michelle, this was published November 23rd. So not maybe 2 weeks ago. The thing about Vanguard is this is their outlook summary, which highlights their top level findings, which is going to be distributed in mid-December. So Vanguard's hasn't technically come out all the way yet, but they give you the highlights. And that's basically what I want to give y'all anyway. So when we look at, say, and I want to make sure I'm zooming in so this is really good on my screen. When you look at Vanguard, the global economy in 2023, beating back inflation. So there we go again, right? We're going to figure out what's the recurring themes and what's going to be hot to pay attention to in 2023. So inflation, once again, in 2022, economic and market outlook, we outlined how we believe the removal of policy accommodation will shape the economic and financial market landscape. Policy has, in fact, driven conditions globally in 2022, one of the most rapidly evolving economic and financial market environments in history. Whew. But one fact has been abundantly clear. So long as financial markets function as intended, policymakers are willing to accept asset price volatility and a deterioration in macroeconomic fundamentals as a consequence of fighting inflation, the stabilization of the global consumer behavior, cyclical acceleration in demographic and geopolitical trends, and rapid monetary tightening suggests a more challenging macroeconomic environment in 2023 that, in our view, will help bring down the rate of inflation. Woo! That was a lot of big words to say a lot of nothing. At the end of the day, a stabilization of global consumer behavior basically said people need to stop spending. Demographic, they talking about, geopolitical, that's Russia and them, more tightening. So let's go to, they said global inflation is persistently surprising. What a recession by any other name? Give me 1 second. I want it. Okay, here we go. This is the good information from Vanguard. Why does it keep doing it? Hopefully that's big. Hopefully that's big enough for y'all to see on the screen, man. So Vanguard's economic forecast. This is what the big thing that came out of their early report or their summary. So for GDP growth in 2023, Vanguard estimates the United States at 0.25 to 0.5%. And they're saying this is a year-over-year change in fourth quarter growth. So just FYI, that if you ask, like, how long is that? And the consensus is 0.9. So, that seems kind of weird when you think about, you look at, say, the ATL Fed economic forecast, and I think the fourth quarter GDP is supposed to be like 3 or 4%. So again, let's think about the information we're taking here and what data we already have. If the fourth quarter GDP is projected to be positive, but yet Vanguard's economic forecast says that by the end of 23, we should be at 1%. What does that mean, or what does that suggest might happen in 2023? We might see a drop in GDP. So, think about it. And here's the trend, 1.8%. So again, Jerome Powell has talked about it. He's willing to accept below trend growth, right, in order to tame inflation. These are the exact words he said at press conferences. Expect below trend growth for some time in order for me to tame inflation, right? And now we're seeing it in Vanguard's economic forecast. We look at Euro area, because I have been talking about Europe. They have 0% GDP. And the consensus is 0.2%, and the trend is 1.2. UK, they have negative 1% to negative 1.5%, and then they have negative 5%. And China, believe it or not, they have at 4.5%, and 5% is the consensus. So I'm not even gonna say it, but they saying China is the one that's supposed to have the most growth in 2023. And if China finally has its reopening, I can see that justification. So maybe an opportunity there. I'm sorry. Unemployment rate. This is another thing that Jerome Powell has talked about. I'm trying to zoom in without. There we go. That's a little better. Unemployment rate. Vanguard has us forecasted at 4.4% by the end of 2023, and the consensus is 4.4%. And then I'm not sure what this NAIRU is, but the range is 3.5 to 4%. Again, what is this data telling us now, right? So we've been seeing a lot of layoffs lately. A lot of companies been coming out laying off people. And so Vanguard believes that eventually by the end of 2023, that we will see unemployment go up to 4.4%. Let's think about the data we have right now. What is the current or the last unemployment rate we got? It was 3.7. So to go from 3.7 to 4.4, that's going to take a lot more layoffs. That's ugly. 3.7 to 4.4, it's got to get pretty ugly if we're going to believe Vanguard's economics forecast, right? You know what I'm saying? I'm not saying we have to believe it, but this is the data that they're putting out, right? And so these are like some of the assumptions that at least I think of. Wow, you look at the unemployment rate in the Euro area, they have that at 7.4, and then the consensus at 7.7. You got UK at 4.7 and China at 4.7. The last thing, oh my God, man, I keep doing that. Oh, I finally got it. Okay, there we go. It's a little bigger. Headline inflation for 2023. This is where I don't know if I necessarily agree, y'all. And comment in the chat if you agree or not. But Vanguard says they got headline inflation coming down to 3% by the end of 2023. I don't know. And the consensus is 2.4. So they really like see inflation crashing in 2023. Well, at least Vanguard does. And then you got inflation in Euro area coming down to 5.3, and you got consensus at 5.2. You got UK at 6.3, and consensus at 6.5. You got China at 2.2, consensus at 2.3. Now, mind you, UK is at 10%, 9% inflation, and they say by 2023 it's gonna get down to 6.3. I don't know, man. That's tough. We'll see. And then you talking about Vanguard doing 3%. We'll see. So that's Vanguard's economic forecast. Let's see what else they have. Here we go again with that global fixed income, brighter days ahead. Although rising interest rates have created near-term pain for investors, higher starting interest rates have raised our return expectations more than twofold for U.S. and international bonds. We now expect U.S. bonds to return 4.5 to 5.1% per year over the next decade, compared with 1.4 to 2.4 in annual returns we forecasted a year ago. So there we go again with bonds. There we go again with them daggone bonds again. Another big player talking about bonds. Global equities. Let's see what they say. Resetting. What? Goddamn. Resetting expectations. Took the words right out of my mouth. I said that earlier. We had that when we was reading Blackrock. You're going to have to reset your expectations. Well, reset your expectations. Rising interest rates, inflation, and geopolitical risks have forced investors to reassess their rosy expectations for the future. The silver lining is that this year's bear market has improved our outlook for global equities through the Vanguard capital markets model. Projections suggest that there are greater opportunities outside the United States. Emerging markets. If the dollar starts to retreat, that could make emerging markets attractive. If we have a recession and the dollar fall, that could make emerging markets. That's basically what they're saying. Let me see if there was some comments real quick. So I want to show this. So when I said I don't know what the NAIRU is, it's the non-accelerating inflation rate of unemployment. We probably even need the definition, bro, but I appreciate you, Curtis. Tim said a 5% drop. Nah, he's probably talking about inflation. And then Dave said if there's really an inventory bubble, price needs to come down. It's weird because the Fed is trying to crash demand while inventory levels are high. I got you. Yeah, it's weird, bro. Weird. So getting back to resetting expectations. So Vanguard, right? Stretch valuations in the U.S. equity market in 2021 were unsustainable. I think a few people actually said that, like, yo, there's no way the market is going to keep running this high. And our fair value framework suggests that they still don't reflect our current economic realities. Here we go again. Another big bank talking about valuations don't reflect the current economic reality. We also see a high bar for continued above average earnings growth, especially in the U.S. Correct. If we have a freaking recession, then of course earnings are going to come down, right? Although U.S. equities have continued to outperform their international peers, the primary driver of that outperformance has shifted from earnings to currency over the last year. A 30% decline in emerging markets over the past 12 months have made valuations in those regions more attractive. We now expect similar returns to those of non-U.S. developed markets and view emerging markets as an important diversifier in equity portfolios. So to summarize all of that, basically what they're saying is that U.S. was able to outperform, right, for a very long time. And now that things have shifted because we have a strong dollar, right? Currency, people have been talking about their forex, their currency impact or their foreign impact. And you mentioned you've had a 30% decline over the past year. So that's a good discount, right? They basically saying, yo, the emerging markets are down 30% in the past 12 months. And we expect going forward that you could add this as a small diversifier in your portfolio. So what does that mean to a retail investor? So let me give you some perspective. What I would say is, to me, I would look at this as like a pivot, right? Let's say the US market, just everything going is just getting crushed, and it's just like, I'm trying to find a return or something. Well, maybe a pivot in my playbook may be, let me look at these emerging markets, right? If I see the dollar is going down, maybe China, as much as it's hated, might be an opportunity. It's the only region that's actually expected to have GDP growth over 1%. So it's like in your playbook in 2023, something you might go to if you need a trade or something like that. You might remember, oh, you know what? They talked about that, there's opportunities outside the US. Let me see what Alibaba doing, or let me see what some type of stock is doing. And then next thing you know, you found an opportunity that people not hip to, and you able to generate some positive returns. And the other important part is that it's a diversifier. Let's focus in on that word, diversifier. So it's not saying put your whole freaking portfolio in it or anything like that. It's saying this is just a small piece to kind of, help, sustain through this rough time that we going through. All right. And at the end of the day, that is the end of their outlook. So that's basically Vanguard. So summarize Vanguard. At the end of the day, they like bonds. We didn't get to see any of their tactical views, but they do believe that a recession is needed. We got to look at their economic forecast and all of that good stuff. So that's basically Vanguard in a nutshell. So the next big bank, and as we go through these, they actually get pretty quicker because some of them, I kind of went through already. So JP Morgan, right? So JP Morgan is the second, if behind Blackrock, is probably JP Morgan is probably the second biggest asset manager, in the United States, right? And so it's very important to know what JP Morgan sees for 2023. So let's get into JP Morgan real quick. 2023 market outlook. Stocks set to fall near term as economic growth slows. Right? So this is the key economic and market forecast for 2023 from JP Morgan's Global Research. Shout out to Michelle. This was published December 8th. So this one is fairly recent. Damn, this is today. Or they must have, today, or they must, this is today. This is fresh off the press, hot off the press. Let me zoom in a little bit more so y'all can see that. All right. Starting it off with their overview. The global economy is projected to expand at a sluggish pace of around 1.6% in 2023 as financial conditions tighten. The winter aggravates China's COVID policy and Europe's natural gas problems persist. So when we think about JP Morgan, the first thing they coming off is that they think that the global economy is going to slow down to about 1.6 due to financial conditions. They think China's, they don't believe China's going to reopen. Now, it's funny because China seems to be reopening, but they believe it's going to aggravate. But we're starting to see the reverse. So JP Morgan might have a wrong outlook on this one. And then Europe's natural gas problems, we know that still persists. The global economy is not at imminent risk of sliding into a recession. How about that? As the sharp decline in inflation helps promote growth, but a U.S. recession is likely before the end of 2024. Yo, if that ain't a good way to straddle the fence, boy, they straddling the fence. How you gonna say the global economy is not at imminent risk of sliding into a recession, but on the flip side, say the U.S. is likely for a recession before the end of 2024? If the United States goes into a recession, the global economy is likely to go into a recession because we are the global economy. Like, great way, great job, JP Morgan. Who pays these guys? And then it says in the first half of 2023, the S&P 500 is expected to retest the lows of 2022, but a pivot from the Fed could drive an asset recovery later in the year, pushing the S&P 500 to 4,200 by the year end. Whoa, JP Morgan is sounding kind of bullish here now, huh? They said first half of 2023, the S&P 500 is expected to retest the lows of 2022. First half. So that means before they expect by June of 2023 that we will come back and retest the lows of 2022. And from there, if we get a pivot that we could recover from those lows and go all the way to 4,200 by year end. Now, I want to know what the math would be, but if we go back to say 3,500 and then bounce back to 4,200, that's a hell of a run. That's definitely a big bounce. That's going to be at least 30%, 35% from 3,500 to 42. Somebody do that math for me real quick. That's going to be a nice bounce. Okay, let's see what else they got for us. And this is from the great Marko Kolanovic, right? I know you guys, or if you watch CNBC and all that stuff, y'all are familiar with him. He said he always makes calls and all of that. But he's the chief global market strategist and co-head of global research at JP Morgan. Bet my guy Curtis said that would be 20%. So my man, turn 20%. 20%. And shut up, Tim. You on your computer. Thank you, Tim. 3,500 to 4,200 is 20%. A new bull market. Ain't that what they would say? 20%. A new bull market. All right. There is good and bad news for equity markets and more broadly risky asset classes in 2023. The good news is that central banks will likely be forced to pivot and signal cutting interest rates sometime next year, which should result in a sustained recovery of asset prices and subsequently the economy by the end of 2023. The bad news is that in order for that to happen, we will need to see a combination of more economic weakness and increase in unemployment, market volatility, basically saying we need to see the VIX go above 40 and we need to see the market come down, decline in levels of risky assets, a decrease in the market, and a fall in inflation. All of these are likely to cause or coincide with downside risk in the near term. So again, summarize. Let's really break down and understand what he's saying, right? The bad news, right? In order for the Fed to pivot, this is your list of requirements that we need to see happen. We need to see more economic weakness. Think about the reports we've just read. We need to see GDP come down, right? That's one of the economic weakness. We need to see unemployment go up, right? Vanguard talking about 4.4%, and all of that stuff, right? Then they all have said equity valuations are too high, i.e. market volatility. right? A decline in levels of risky assets. And then they also want to see a fall in inflation. And from some of the reports we've been seeing, they're talking about a really steep fall in inflation. We need to see all of that happen in order for what to happen, in order for the Fed to say, and when they say pivot, we're not talking about, we talking about not only them stop raising rates, they already said they're going to have to hold longer, but when do we get into that regime of they're actually going to start cutting, right? That to me is the pivot, when they have to start cutting, right? And it makes sense that eventually, if we had all this stuff they talking about, GDP come down, unemployment go to 4.4%, market volatility, and people out of jobs, then eventually, yes, he's going to have to cut rates. They're going to have to make money cheap again. He's going to have to come in and save the day. It all makes sense. And we didn't even get into the housing crisis yet, or the housing correction. Like, that's another thing that when they say a combination of more economic weakness, we haven't even mentioned the housing crash, but that's another criteria that Jerome Powell has talked about. He want to see housing prices come down. So that's another thing that you got to, think about in 2023, as this is the information that they're giving us, right? And so what is the forecast for global economic growth, right? So they're saying 22 was a shocking year against historic volatility in 22 and 21. We saw the deepest global downturn on record, followed by the strongest rebound. 2022 growth outcomes were far more stable, but this year has been remarkably turbulent, with the global economy hit by multiple adverse shocks, from supply and demand issues spilling into labor markets, and a third major wave of COVID-19 to Russia's invasion of Ukraine. Now, remember how I said earlier I read the last year's outlooks? Like, I think that was some of the stuff that caught the market off. Like, people talked about geopolitical risk, but Russia actually invading Ukraine was a big thing. I think China persisted in their COVID-19 stuff longer, and that really, again, messing up supply and demand, and them shutting down factories and continuing to basically have shutdowns all the way to 3 years into the pandemic. That did mess up a lot of those outlooks. So it's funny to see how they're kind of revising how they feel. Turning to 23, right? The monetary policy tightening drag is building, and central banks remain on the march. So turning to 2023, monetary policy tightening drag is building. So they're basically saying that all those interest rates, they haven't taken effect just yet. It's dragging, but it's building, it's coming, and central banks remain on the march. Even though the tightening is on the drag or lagging, central banks are powering ahead. There's, that's pow. I gotta keep on going. On 31 countries, JP Morgan research tracks, 28 have raised rates. So that's the whole global thing. And there's likely more to come, right? Based on this current guidance, the Fed will deliver a cumulative adjustment of this is a good one right here. This is a good one. Based on its current guidance, the Fed will have delivered a cumulative adjustment of close to 500 basis points on rates through the first quarter of 2023. What does that mean? JP Morgan is saying that they feel that we will get to 5% by March. Where are we right now, right? And think about how, what now you kind of can get an idea of, okay, expectations for the December meeting and February and March. If he does a 0.5, a 0.25, a 0.25. Well, right here, JP Morgan is saying they believe we'll get to, that 5% by the first quarter. And they're saying they expect for them to pause by the end of the first quarter. So remember that. This is JP Morgan. Then we get into GDP growth in 2023. Let's see how they stack up against Vanguard. So they have US at 1%. They got the global at 1.6. They got China at 4. There go China again. Emerging markets at 2.9. And they got Euro area at 0.2. The global GDP growth in 2023 is forecast. Okay, basically what I just read. Let's see. Okay, here's another thing that sticks out to me. The global consumer CPI inflation is on track to slow toward 3.5% in early 2003 after approaching 10% in the second. Yo, this be that stuff that I be like, bro, they crazy. How? The global consumer CPI is on track to slow to 3.5% in early 2023 after being 10%. That's a fast drop. Circumstances warrant considering a range of scenarios. The dominant events across different scenarios presented in the U.S. Presented is a U.S. recession before the end of 2024, but the timing of this break, the path of the Fed policy, and the reverberations for the rest of the world vary. They basically talking out both sides of their mouth. Let's see what else we got. Stock market outlook. After a year of macroeconomic and geopolitical shocks, investors responded by derating the S&P 500 price to earnings ratio as much as 7 times. That's that PE, that PE SPX chart, that we be using. I'm gonna look at that to see if it's really come down seven times. I wonder, has it come down 7 times? I don't think it's come down 7 times. Then they go on to say, while some speculative growth segments crashed 70 to 80% from highs. She's talking about ARK. They talking about all the high flyers. That's who crashed 70 to 80%. Although fundamentals have been resilient throughout these shocks, this year's constructive growth backdrop is not expected to persist in 2023. Fundamentals will likely deteriorate as financial conditions continue to tighten and monetary policy turns even more restrictive. Wow, look at this. They said the economy is also likely to enter a mild recession, right? With labor market contracting, so unemployment going up, and then unemployment raising to around 5%. So we got JP Morgan talking about 5% unemployment. So they really see more layoffs coming. So, man, people might want to buckle up, man. Consumers with a cushion of savings from lockdown have mostly exhausted their post-COVID excess cash, and for the first time are getting hit by a broadening negative wealth effect from all assets simultaneously, whether it's housing, bonds, equities, alternate private investments, or even crypto. This proverbial snowball should continue to gain momentum next year as consumers and corporates more meaningfully cut discretionary spending and capital investments. Yeah, then I think they say we in the first half of 2023, we expect S&P 500 to retest the lows. Fed overtightens it to weaker fundamentals. This sell-off combined with disinflation, rising unemployment, and a declining corporate sentiment should be enough for the Fed to start signaling a pivot, pushing the S&P 500 to 4,200 by the year end. And this is by whoever this cat is. So he basically said, the sell-off to the lows in conjunction with inflation somehow coming down, with rising unemployment and declining corporate sentiment, all of that shit have the Fed pivoting. I don't know if I agree with that. Don't know if I necessarily agree with that. Then they keep, just repeating themselves. Commodities outlook. I'm going to skip over some of that. Skip over that. What was that? Emerging. Here we go. Emerging outlooks. I'm gonna skip over that. And basically, yeah, that was the end. Basically, that's the end. So that's JP Morgan. So summary, right? In summary, when it comes to JP Morgan, I feel like JP Morgan put their foot in their mouth. Like they talked about no recession, then there is a recession. So they think we're going to hit a low. They think we're going to go to 4,200 by the end of the year. So I'm going to say JP Morgan wishy-washy. You know what I mean? We can take, we got what we got from them. It is what it is. Let's move on. Now, this one I'm real interested in because this is Morgan Stanley, right? I'm going to do Morgan Stanley, and then I'm wrapping it up with Goldman Sachs. So we're almost at the end. I know I'm pushing time, but this is really good. Really good info here. The reason why I said Morgan Stanley is probably a good one to review is because last year, Morgan Stanley was the only bank that was like truly bearish, and I feel got the call right. When you think about last year outlooks, most big banks was bullish, talking about 5,000, 5,200, and all that. The only like investment bank that was like, yo, we bearish and outright called a bear market from the jump was Morgan Stanley. Morgan Stanley called it from the jump. And so I'm really interested to do Morgan Stanley because, they got it right last year. So again, shout out to Michelle. This was published on November 22nd. So this is maybe 2 weeks old here. And this is 2023 Global Investment Outlook, a year for yield is what their title or theme is, right? In an environment of slow growth, lower inflation, and new monetary policies, expect 2023 to have upside for bonds, defensive stocks, and emerging markets. There go that theme again, y'all. Bonds, defensive stocks. So think about your defensive sectors. And then emerging markets. That emerging market theme is persistent because if the dollar falls, emerging markets, China, again, not saying, but China could be a pivot, right? You know what I'm saying, or opportunity, but there goes that theme again, right? And this is Morgan Stanley. Now I'm gonna give Morgan Stanley a little bit of credit because they got it right last year. So upside for bonds, so they like bonds, TLT. They like defensive stocks, and then they like emerging markets. So we have to keep our eye on that. Now, let's kind of get into and kick off what they're talking about, right? Investors may find themselves a bit whiplash in 2023 as inflation is some of this year's other dominant market trends fully reverse themselves. For markets, this presents a very different backdrop in 2022, which was marked by resilient growth, high inflation, and hawkish policy, says Andrew Sheets, who is the chief cross-asset strategist for Morgan Stanley, right? Overall, 2023 will be a good year for income investing. Now, when people talk about income investing, that's dividends, right? Or fixed income growth, bonds, right? Because you get a good yield from bonds. That's income investing. But oh my God, look at that. Bonds, the biggest losers of 2022 could be the biggest winners in 2023. TLT, baby. As global macro trends temper inflation next year and central banks pause their rate hikes, this is particularly true for high quality bonds. God damn it. HYG, high yield corporate bonds, high quality bonds, right? Which historically have performed well after Federal Reserve stopped raising interest rates, even when a recession follows. Follow me, y'all. Follow me, y'all, because when we talk about remember how I mentioned bonds could outperform when the equity markets doesn't do good. Again, shout out to Tim. His advisor showed the video where he talked about bonds could do well. And here we go. We have another fund or big bank talking about it, right? And then they say emerging market equities and debt, which were early to underperform this economic cycle, could be early to recover in the next, right? As was the case after the dot-com bust in the early 2000s and in 2009 following the financial crisis. So they basically like bonds, and then they're saying again that emerging markets could outperform. And I like how they pointed out that bonds could do well even after a recession. So like in a stagflation environment. Let's see. I got a few questions here. or just let's see. Analysts are still slightly bullish for 2023 earnings. They need to stop all that nonsense. Then I know the Fed is actually making progress. Correct. Eric said we barely moved 1% down on CPI, yet they're calling for another 4%. Yeah, man. Christine say emerging markets. Would India be a pivot as well with some companies moving out of China? I would say yes, right? So and it's funny you mentioned India because we haven't seen India come up in any of these, but you're right. India would be one, and that would be kind of one of those things where your research would pay off by kind of knowing this information and seeing like, okay, these are what these big banks are saying. What can I find on my own? So that's a great one. I think India would be a great pivot, especially with a lot of companies moving manufacturing to India and all of that. It could be a great opportunity, especially I would say long term as well. All right, like don't think about just options and stuff like that. Think long term as well. Like India could be a great long term opportunity. Trevor say, how serious should we take these reports? How serious should we take these reports? Are looking I'm guessing you're gonna say they are looking at common themes because they always update in their position. How serious should we take these reports? Demons because they're always updating these positions. Okay, I kind of get what you're asking, and that's why I said, like I mentioned earlier, you do have to remain agile, right? So these were published maybe 2 weeks ago. I would say that most big banks, they aren't going to. You have to think about big banks. They have big client money, so they're not changing their opinions weekly or daily like a retail investor. When they have these themes and stuff like that, they're willing to let these things play out for the entire year. Now, I will say that some of them send out monthly updates to tell you when they might have a tactical switch or anything like that. So you do want to pay attention to that. But as far as like just, again, great question. How serious should you take them? I would say you want to take it to a level of degree where it's more about information and data gathering. What I'm trying to do here is break down what they're saying, right? Take in what they say, look at the data we have, what we know, and decipher. Okay, they're saying this is, these are the narratives we've been hearing already. All these banks kind of agree, but do we agree? That's where we can have an open conversation to say, do we necessarily agree with these banks, right? So it is a level of how serious should we take it, and we should question some of the information that they're putting out to the public, right? That's another reason I'm doing this, is that we should question it. They're talking about inflation dropping crazy. We should question that. How do they see inflation dropping so fast like that? What data or what information they have that we don't have that's telling them it's going to drop this way? Because from what we see, we don't see nothing changing. Like I don't see food going down necessarily. Gas is still high. Rent is still high. And I don't see them dramatically decreasing super fast or overnight. So where are they getting this information that inflation is supposedly just supposed to drop off a cliff? I would love to know. So great question, Trevor. Got off track a little bit, but want to, interact with the chat a little bit. So let's go back into their other key takeaways for 2023. They said the 10-year treasury yields, look at that. Another thing that we look at, the US 10-year, right? They said will end at 3.5 versus the 14-year high of 4.2 in October 2025. Man, I feel like I want to pull up the charts right now just because I want to check that. Actually, I got to do it, y'all. I got to go to our indicators because I wanted 3.5. We already there. I'm sorry, I had to do it. We're already there. It's at 3.5. And when you talk about like structure, like this was a wick, the top of the wick. We broke this low, right? So this is where we broke market structure. We broke market structure right at 3.5. I don't know if y'all can see that. Let me zoom in on my chart a little bit more because it looks blurry on my screen. So I try to like make it as clear as possible for y'all. But look at that. Like we broke structure right at 3.5, bro. That's crazy. So all right, let me pull that down. This not all about. It's not about the charts tonight though. It's not about the chart. But it's funny they said that. Well, so they think that the 10-year is, yeah, yep, I told you. I'm looking at comments and stuff. Hold on, let me pull these up. So Trevor said, okay, I want to see all the data and pull out what they are saying together. Maybe they off or look for the follow-up. Yeah, oh yeah, that's what I said. I'm, if I get any updates, bro, we're gonna, I'm gonna continue to kind of do these updates. Because this keeps you abreast, and again, we can question them on all of that. He said maybe they factor in the rate hikes from 2022. I believe it will be 3.75s and 2.50s. Maybe they factor in the right. Oh, as far as why inflation gonna come down so fast, maybe. I don't know. He said about TLT, I didn't know what to think when it hit that low of 91.85 last month. It bounced and has been running ever since. Oh yeah, man. And I think I was like, yo, at 90, I'm like, man, you gotta buy that here. Well, at least I know I told the runners. Shout out to the runners. I definitely got timestamps on that. And okay, so let's get back into this daggone thing. So they believe the US 10-year is going to stay where it already is for 2023. I call that, I question that, right? So that's something that I would question. With favorable pricing, securitized products such as MBS, mortgage-backed securities, MBS, will offer upside. S&P 500 will tread water. All right, here we go. We got another yearly prediction from a big bank. S&P 500 will tread water ending 2023 around 3,900, but with material swings along the way. So they basically are saying the market is about to go sideways for the next year, and it's just going to have swings. So we're just going to be trading in a zone, but we ain't about to go nowhere for a whole year. They also say the US dollar will peak in 2022. Well, how about that? The DXY, we've been looking at that, and declines in 2023. Remember how I said in the thing that I was like, yo, the dollar showing weakness, and that the past 3 months has been making lower highs. I have to always make sure I say that correct. So for the past 3 months, the highs that it has made have been lower. So lower highs. And I mentioned that if you go back and watch those other videos, that the dollar still looks weak, and that if we wanted to continue weakness, it was cool for it to bounce up like it did and kind of cause this pullback it's having, but eventually you go up to come down. And if you look at that dollar, you know what I'm saying? If you look at the dollar on a monthly, I was saying how it has a monthly order block at 103, 101. But anyway, y'all feel me, man. All this is tying in, though. It's dope, right? It's dope. I hope it's dope. It's dope to me because it helps me keep my thoughts going. So dollar peak. Here we go again. Emerging market and Japanese equities could deliver double-digit returns. So who asked the question about India? Apparently, the opportunity seems to be Japan. But again, emerging market could be India. And then we have oil will outperform gold and copper, with Brent crude and the global oil benchmark ending 2023 at 110. So they see oil going back up to 110. Oil go back up to 110. How the hell does inflation go down? Can somebody answer that question? If oil go back to 110, how do gas prices go down? How does inflation come down? Or what comes down to cause inflation to go down? That's why, they be like, that's where I'm like, the data leads me to certain questions that therefore has me question things they say. Overall, investors will need to be more tactical and pay close attention to the economy, legislative and regulatory policy, corporate earnings, and valuation, says Mike Wilson. Shout out to Mike Wilson. He won Advisor of the Year. He's been calling the market all year and ain't missed. So shout out to Mike Wilson. Because we're closer to the end of the cycle at this point, Wilson says trends for these key variables can zig and zag before the final path is clear. While flexibility is always important to successful investing, it's critical now. Flexibility, my guy, flexibility. Let's see. Bonds make a comeback. So we already kind of talked about the bonds. Trends point to higher yield equities. Well, trends point to high yield. Trends point to, let's see. Okay, equities next year, however, are headed for continued volatility. We forecast the S&P ending next year at 3,900. This is how they feel about equities. Consensus earnings estimates are simply too high. The PE-SPX chart. I'm trying to tie everything in that, like, the stuff I do on my channel. I'm trying to make sure I tie it all in. This is the reason why I talk about those indicators. Consensus earning estimates are simply too high to the point where we think companies will hoard labor and see operating margins compress in a very slow growth economy. So what does that say? When you listen to earnings calls, we want to pay attention to operating margins. Are they getting squeezed? A great earnings call to go listen to would be Costco. They just had earnings today. I haven't listened to it yet myself, but I will. And shout out to Dave, because on Sativa Saturday, he talked about some of the things to look forward to. So I'm going to go back and listen to that. And then I'm going to go listen to the call and see what I get from that. And again, data gathering, right? Yeah, so margins, right? Margins. To that end, investors should consider the high yielding parts of equity markets. Here we go. All right, here we go. Including consumer staples, XLP, financials, healthcare, and utilities. So now we got Morgan Stanley. They are going into 2023 high on consumer staples, financials, healthcare, and utilities. Okay. They ain't even say energy. They didn't say industries either. They didn't say consumer discretionary. They didn't say tech. They said European equities could offer modest upside with a forecasted 6.3 total return over 2023, as lower inflation nudges stock valuations higher. This should ultimately more than offset the 10% earnings per share decline we expect from weaker top line growth and material marginal disappointment. He said head of Europe, financials and energy are more likely to perform well in this environment. Ooh, okay, I gotta watch out for that. So Morgan Stanley is basically saying, hey, Europe could actually have a little bit of upside, and that if their inflation comes down, it could nudge their valuations a little bit higher. But the reason why I said I need to watch out is because, again, I did a video on one of my I had to change the title for search purposes, but Europe recession, a short idea or way to hedge, the ETF Feds. Now I went through Feds. It's actually kind of heavy financials. So if financials and energy are more likely to perform, I might have to reconsider that short. I'm gonna have to pay attention to that, So this is one of those things where I got some data, and it's like, I might need to pay attention to that because they see some stuff that I need to study. Talking about emerging markets in Japan set to recover. So again, China. Okay, no, here's what I do want to point out as far as what I was saying. This has been a major bear market for emerging market, but the tide could be turning. Valuations are clearly cheap and cyclical winds are shifting in favor of emerging markets as global inflation eases more quickly than expected. That's questionable. And where were we at? And more quickly, the Fed. Okay, here we go. The Fed stops hiking rates in the US dollar decline. So this was the thing that I was talking about, as far as the US dollar declining and that being good for, global markets, right? He says, adding that over the last several economic cycles, emerging markets have recovered before U.S. markets. So what they're saying is, as U.S. markets go into a recession, emerging markets are typically recovering, and therefore the opportunity is when the U.S. market has a pullback, you could offset that pullback by maybe having some exposure to emerging markets because they've usually recovered before U.S. markets. Now, again, do your research on all that, but again, just information gathering, and this is from the words of Morgan Stanley. What are we looking at here? Bull and bear case outlook for global equities. This is some good information here. So Morgan Stanley has a bull case of 4,200. Now, where do we hear 4,200 at? What was that? Was that JP Morgan? Yeah, JP Morgan also said that we could go down and then bounce to 4,200. Okay, so same thing from Morgan Stanley. Their base case is 3,900 and their bear case is 3,500. 3,500 does what? Retest the lows, negative 12%. And that's at a current price of 39.56. And where did SPX close today? I want to say it closed at like 39.63 or something like that. So, I mean, it's pretty relevant right now, right? It's pretty relevant right now. And then here's your emerging market outlook. Wow. I'm just going to look at the percentages. For Europe, bull case, 18%. I definitely need to be careful. Base case, 3%. Bear case, 15%. Emerging markets, EM, right here. Bull case, 27%. That's really good. Base case, 12%. Still pretty solid. And then bear case, negative 18%. And so y'all know how I feel about percentages. With any ETF that you are looking at or whatever, you can use these as baseline numbers. 12%, 27, 18. That gives you a nice trading range, and you can work some magic with that. Let's see. This came from November 13, 2022, and that's it. That's Morgan Stanley, right? And now I'm at 1 hour and 15 minutes. So I'm gonna try to make this real quick. It looks like I'm gonna have to go solid 90, hour and a half, but that's cool. People who stay on, you get good information. But I'm gonna go through Goldman Sachs, and with Goldman Sachs, I'm just gonna look at just their U.S. outlook. Now, what I want to say about Goldman Sachs is that if you go to their website, they have outlooks like broken up. So like this is a total like outlook on the whole global outlook. And actually, I'm gonna do this one. So the macro outlook per Goldman Sachs, right? This is what they're saying, and then I'm gonna just do their I'm gonna just do just the summary. Global growth slowed through 2022 on a diminishing reopening boost, physical and monetary tightening, China COVID restrictions, property slump, and the Russia-Ukraine war. We already knew that. We expect global growth of just 1.8% in 2023. So I think they might have a higher global growth than most people. And then they say as U.S. resilience contrasts with a European recession and a bumpy reopening in China. So they do believe Europe goes into a recession, and they think the reopening in China will be bumpy. And let's see, U.S. should narrowly avoid a recession. All right, Goldman Sachs, U.S. should narrowly avoid a recession as core PCE inflation slows from 5% now to 3% in late 2023, with a half-point raise in unemployment rate. Let me break that down. So they think core PCE will go from 5% down to 3% by late 2023. We're going to watch and track that because we know we watch the PCE numbers. So, and then they think that unemployment will raise by half a basis. So if unemployment is at 3.7, you add 0.5, their estimate is 4.2. They think that unemployment has to get to 4.2%. So they be trying to code stuff. To keep growth below potential amidst stronger real income growth, meaning they don't want to see wage inflation, we now see the Fed hiking another 125 basis points to a peak of 5 to 5.25. We don't expect cuts in 2023. See, now Goldman Sachs is really, this is some good stuff. They're saying that they expect another 125 additional basis points for us to get to 5.5 to 5.25. And we can assume by, say, the first quarter. And they don't expect any cuts in 2023. So that's, uh-oh. Damn, I didn't mean to do that. I don't know. I hope I ain't mess it up. All right, there we go. All right. Ooh, look at this. They answered that question. How can core inflation fall so much with such a small unemployment hit? The reason we think is that the cycle is different from prior high inflation periods. First, post-pandemic labor market overheating showed up not in excessive employment, but in unprecedented job openings, which are much less painful to unwind. Therefore, they're basically saying, hey, the hiring freezes, all that stuff, you can cut all that out. Second, the disinflationary impact of the recent normalization in supply chains and rental housing markets still has a long way to go. So they believe that when the supply chains and stuff like that catch up, and when housing prices and the rental market goes down, that's how you'll see inflation drop. So they're saying goods and services are going to drop, and then your shelter is going to be the area that drops. And then third, long-term inflation expectations remain well anchored, meaning that Jerome Powell still keeps talking about this 2% long-term inflation, their goal of getting to 2% inflation. If Jerome Powell were to ever budge and say, hey, look, guys, we have to adjust to a new normal, and the long-term inflation rate will now be 2.5%, 3%. Bruh, I don't know what could happen, but just know, now your long-term inflation, it ain't well anchored no more. It's now adjusted. And I know I've been saying for a while, I wish he would let this 2% go and just kind of go up a little bit higher, because I don't know if we're ever going to get back to 2%, bro. Personally, I mean, I could be wrong, but we'll see. Only time can tell. Where else? Okay. The Euro area and the UK are probably in recession, mainly because of the real income hit from surging energy bills. We expect only a mild downturn, as Europe has already managed to cut Russia gas imports without crushing activity, and is likely to benefit from the same post-pandemic improvements that are helping avoid a U.S. recession. Given reduced risk of a deep downturn and persistent inflation, we now expect hikes through May with a 3% ECB peak. So they believe that UK is already in a recession, and that they don't see it really getting too much deeper, in that Russia or Europe has already made moves to kind of start weaning itself off Russia. We're gonna see how that go though, because I heard that it's not looking too good, and that they could possibly run out. But that's basically what Goldman Sachs is talking about there. Then you have China is likely to grow slowly in the first half, right, as the April reopening. Now, this is key. They're saying that China is likely to reopen in the first half around April. That could trigger an increase in COVID cases, which keeps the caution high. So what they're scared about is when they finally reopen and the COVID cases go high, that China going to re-lock down, i.e. the bumpy reopening, right? But should accelerate sharply in H2 on the reopening boost. Our longer run China view remains cautious, right? Because of the long slide in the property market, as well as slower potential growth, right? And that's pretty, then they got some nice graphs. They talk about how the cycle is different, how we're able to avoid a recession. They go through some exhibits. Goldman Sachs, I ain't gonna front, theirs is like super duper deep, but the fact that I'm running on like an hour and a half right now, you know what I'm saying, I kind of want to just speed through. But I would definitely say Goldman Sachs, their macro outlook is phenomenal. So definitely go check this one out. And then this is their, what did I really want to see here for you for the US market? Because I kind of already did mostly what they said about the US market. Let's see. You might be able to just kind of do it there. Okay, no, this was the one thing that I wanted to share. Okay, for the United States, this is what they said. We expect the FOMC to slow the pace of rate hikes as it shifts to fine-tuning the funds rate to keep growth below potential, but to ultimately deliver a bit more than its price. With a 50 basis hike in December and 325 bips hikes next year, the funds rate to peak of 5.5 to 5.25. Our recession odds are below consensus, even though our Fed forecast is slightly more hawkish than consensus because we expect demand to prove more resilient than next year. So that was the main thing I wanted to talk about from Goldman Sachs was this little gem here. They think that the market goes with a 50 bip in December, and that we actually could see Jerome Powell just do 325s in March or February, March. But then that would mean you would need one additional one in May. If you did it that way, if he did 325s, he would have to do one in May. So again, these are all things that eventually are going to, have huge impacts on the market in 2023. And so I thought that was a key little gem that came out from Goldman Sachs. The third step. Okay, yeah. Oh man, they had some good ones. I'm sorry, y'all. I got to go through this. There's a few good. There's a lot of good information in Goldman Sachs. I'm gonna just at least start from right here. The initial steps. Or I'll just do it. The key macroeconomic question of the year has been whether inflationary overheating can be reversed without a recession. Our analysis suggests that the answer is yes. An extended period of below potential growth can gradually reverse the labor market, bring down wage growth, and ultimately inflation, proving a feasible, if challenging, path to a soft landing. Goldman Sachs essentially believes that we can have a soft landing. Like, it's possible. And they give you the steps. The initial steps to this path have been successful, but have much further to go, right? So we expect another year below potential growth, and the labor market needs some rebalancing. Unlike consensus, they do not expect a recession. A first step in keeping the adjustment is that the physical tightening will help slow the economy. But large tightening in financial conditions engineered the Fed should keep GDP growth near 1%. So they believe that we have a 1% growth in GDP. Consumer spending should grow a bit more firmly as income begins to rise again, but is likely offset by weakness elsewhere, especially in housing. Right. I thought that was some pretty good info. Talking about the wage growth. The reason why I thought wage growth was important is because when we got our unemployment numbers, we saw that I think it was a couple of days ago, and I'm going to talk about this in Sativa Saturday, is how the expectation came in double, and because it just showed that wage growth was still going up. This is going to be a really big thing going into 23 if we can control wage inflation. So as you can see, one of the big banks is talking about that. We expect core PCE to fall from 5 to 3%, driven largely by goods categories where supply chain recovery is now reversing pandemic shortages. So that's one of the reasons why they see core PCE dropping, is that pay attention, right? So when the reports come out, one of the areas you want to look at is the goods area. Is that area dropping? If so, then, we could be on a path to seeing this 5 to 3, and the stuff that they're saying or the information they're giving us could, come to fruition. And yeah, so then it goes into like much, much deeper. And that's it. And that's why I'm gonna just pause it, man. I'm at an hour and a half. There was one more that I had, which was State Streets. But I'm gonna pause there, man. I'm gonna just let y'all do that one. I'm gonna stop sharing real quick and come on screen. I got a few comments here. Shout out to my dog. That's my boy David. He said good shit. Appreciate you for tapping in, my guy. Trevor say, when you gonna give your 2023? When I'm gonna get mine? I will probably give mine closer towards the end of 2022. Actually, I really like to wait till like the end when the year is over so I can see where we close truly. Like I want to see like on the very last trading day of 2023, where do we close? Or I mean 2022, where does the market close? And then I'll be ready to give my outlook. Also I still want to get through like PAL and all of that good stuff. So yeah, be on the lookout for that. That will be coming soon though. That will be coming soon. But I'll say this. You just got an inside look into how I formulate my outlooks. I legit go through these reports, study all this information and data. I compare it, put charts together and matrices and stuff. And I'm like, okay, I put it like this. I'm evaluating my competition. The big banks is my competition. And I'm looking at them and I'm saying they are tactical here, here, here. This is what they believe. This is what they're saying. This is how they position, blah, 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 blah. And when you start to develop a watch list and stuff, I take it a step further of if these are the companies I'm looking at, I can go study option chains. I can go study insider information. Are insiders buying the stock? Are they selling the stock? Yo, I'm telling you, man, it's levels to this shit, yo. It's levels to this shit. But if you're willing to commit to it, you can do it full time because you learn how the game go. I'm not sure how I'm gonna just call you Bunyan, but I'm gonna say let China reopen, let peace come to Ukraine, let Russia market reopen, bull market won't describe that market session. Oh yeah, market might go crazy. Oh yeah, definitely a lot of ifs, right? Only time can tell, man. But again, it's not even about it's not, and he say ifs, it's probabilities, bro. When it comes to the stock market, this is a game of probabilities. So whether you want to admit it's ifs or probabilities, that's the stock market. You have to understand when it comes to the stock market, it is if, because tomorrow, if PPI is good, the market could go up. If PPI is bad, the market could go down. Probabilities or ifs. Which way do you want to describe it? This is super valuable info. 90 of us still here. Appreciate y'all for rocking with me. We'll surely take that. Yep. Trey said, just built my 2023 ETF and mutual fund watch list. Nice, man. Man, if you don't just read that thing. TQQ, SQQ, Yang, USO, XLE, XLF, INDA, Fez, XLV, VHT, YINN, and YANG. One more time. I don't know. Well, I'm definitely going got that going. Y'all write these ETFs down. He just put in the chat. I'm going to go look at all of these. For real. And I ain't never even heard of Yang or Yin. I want to say the VHT is a Vanguard one. I think that's the Vanguard healthcare joint. I know XLV is healthcare, Fez is Europe, and INDA is definitely India. Got to be an India ETF. XLF financials, XLE energy, USO energy. I don't know what Yang is. I would assume probably like a Japanese drink or something. Great review tonight. Appreciate it, Curtis. Solid info. Appreciate it. Andres, thank you. Queen say thanks, Zay. If the Feds get the unemployment they want, wouldn't it in turn create a bear market by reduction of purchasing power? If the Feds get the unemployment that they want, wouldn't it in turn create a bear market by reduction of purchasing power? Yes. So if unemployment goes up, right? People feel like that. Well, I want to say they feel like it. Less people have less money. Less spending and retail shops and all of that stuff. So yeah, so your purchasing power is reduced. Yeah, so it's gonna be demand destruction. Yep, because people are they want people to stop spending. You know what I'm saying? So exactly what you're saying. If unemployment does go up, there's less people with less money. Yeah. Trading with my guy Mark. Appreciate you. He said great episode, bro. Yin Yang or China. Oh, yin and yin and yang are China's TQQ and SQQ. Goddamn, man. Yo, that was like an aha moment. Yin and yang. Black and yo, who came up with them ETFs, bro? I gotta get him one for that one. That's funny, bro. Yin and yang. Appreciate that, Trey. Yin and yang. That INDA doing numbers. See, man, I ain't even look at. I'm gonna go look at it on the charts for myself. Thank you, Zay. Great review. Thank you. All right, that's all the comments, man, for tonight. I'm going on an hour and a half. I'm gonna call it right here. Again, man, I appreciate all those who stayed tapped in for this long video. At the end of the day, man, again, this was just about information and data gathering, right? We had a few questions come up like how serious should you take these outlooks? The market dynamics are always ever changing. Absolutely, right? But within these changing dynamics, you now have a better perspective of when you hear certain things and buzzwords and you watch TV or you hear people talk about certain stuff, you'll understand why things are, why the market is functioning the way it's it is. You have a better you'll have a better outlook on just the global market and everything and where you fit in this as I like to say bigger scheme of things. You know what I'm saying? And it just gives you a good outlook. What did he say? Man, pull up INDA. I ain't at the computer. All right, Tim, I'll pull it up, man. Stick with VOO for the broad market long term. Yeah, or VTI. I mean, shout out to the master investor, VOO, VTI. But I'm gonna keep it a buck. VTI is a very in the debt-free community, y'all know that's where I come from. Like VTI is the shit. That's all they most in the debt free, they love VTI. They can't get them enough of some VTI. You know what I'm saying? Matter of fact, if you even read the Bogglehead's Guide to Investing, that's one of the books that I highly, highly recommend when people ask me learning about investing, is the Guide to Investing, the second edition. They even talk about VTI and VOO in that book, and they highly recommend it. So yeah, I definitely agree. And let me pull up this INDA real quick, man. Messing with Tim, man. Y'all gonna have me on this joint all freaking night, dog. INDA. Let me go look at this ETF. So this is, and let me share my screen. All right, y'all know how I gotta do this. Okay, so oh my. So this is INDA, and so first things first is I gotta start from a monthly, right? And because I can see how y'all can see it on my screen, so I'm gonna just try to do it like that. All right, so hopefully this is clear enough. I know the number is probably super small, but it's currently at 43.35, and it was up 3.4% in October, and then it was up 4% in last month, and now it's on a little bit of a pullback. Yeah, I mean, I guess it could be on a little bit. I ain't gonna really break it all the way down, but let me just go like that. Just on some looking at it real, I guess that could be a double bottom. Shout out to Tim. I guess that could be a double bottom. And if all goes well, 2023, we get, it starts to make a move. But that's INDA. So yeah, over the past 2 months, it's definitely made a nice little move. you can see it's back at this little area where it double top before. But if it don't double top this time, it's definitely going for 45. You know, it probably come from this level here. You know what I'm saying? So yeah, that's the INDA joint. I'm not gonna go too deep, but yeah, man, like I was saying, man, I appreciate you guys for rocking me with that hour and 40. I'm gonna call it a night, man. I will catch you guys Saturday for another episode of Sativa Saturday. Got a good one. You know, we'll do our weekly wrap up, all that good stuff, talk about the narrative, how everything played out, and get ready for real, the Super Bowl of the stock market. Like this next week is for real, the Super Bowl of the stock market. Like I know they be saying that all the time, but this to end this year, this truly is like the Super Bowl because this is going to set the start. This was how we're going to end the year and start the year. You know what I'm saying? This is going to lead up to a lot. So getting this PPI and CPI numbers and then POW, that market direction we get after that is, you know, it's gonna go one way, but then the new year it might go the other way. So, but we'll stay up to date. But at the end of the day, don't forget to press the like button. I hope you enjoyed this session. As always, as I said, catch y'all Saturday 2 p.m. for Sativa Saturdays. Until next time, y'all stay blessed. Peace out.